Hello, hello. Welcome to the 5 Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host for the 5 Talents Podcast. We are super excited yet again to have another amazing guest, Mr. Randy Langenderfer. We're excited to have you. How's it going, Randy?
Abel, thank you. It's a pleasure to be here. And Facebook Live, that's new media for me, so I hope I don't screw up too much.
You're broadcast live around the network. Anyways, it'll be fun. It'll do amazing. And then what happens is some people that are watching Facebook Live right now get a little pre-snippet of the podcast interview, so they don't have to wait for the editing time. But this is pretty cool. I'm excited to have you. And if you don't know Randy, he is one of those individuals that you really want to get to know. He is got a tremendous background in multifamily and commercial real estate investing and syndication investing. And he's invested, in a couple hundred doors, 250 doors as a general partner and a key principal in deals. In addition to that, several thousands of doors as a limited partner passive investor. So Randy, all in all, what would you guesstimate your portfolio overall value invested in one way or the other? How big is the portfolio that you're invested in?
Good question. I sometimes track this. I want to say that the ones I've been in over the last 6 years accumulate to roughly a low 7-figure investment of multifamily. So
yeah, and that's, he's talking about his investment. And how big are how many millions of dollars of real estate does that, your slice represent? Millions of dollars in of those total deals. Yeah, there's doors and deals.
There's 20 plus properties that have been in and out of over the last. I'm still in like 12 of them. I think the combined value is of the purchase price. I don't own all that, but the purchase price of all that is a little north. Last time I looked up, about $350 million. All those assets. Now, granted, again, I have a very small percentage. $350 million.
Yeah, let's. We can talk about the differences of which most people don't really get. However, $350 million is his investment is riding, and like Randy said, he doesn't own $350 million. The bank owns the biggest percentage of it. And outside of that, the rest is split up between other partners and other investors, key principals, general partners, limited partner, passive investors, a lot of different, individuals in one deal. But Randy's money is invested in all of that real estate, performing the same way as everyone else's dollar is. And it's amazing to be able to do that at scale. So he's still actively as a W-2 employee. So Randy, you're working full time while investing in this and making just what I would imagine amazing financial freedom position for yourself. And, you do some great things in the medical field as well. So let me turn it over to you, brother. In your own words, tell us who you are and what you do. And this would be a great place to start.
Well, thanks so much. I just really want to echo the thanks for the opportunity to be a great podcast and a great audience. I've been a fan from afar, and you do a really nice job. But Randy Langenderfer, like a lot of people, grew up, thinking and being taught that get a good education, go to work for a big company, work really hard. Maybe you'll get promoted, and after 35 or 40 years, you retire and live happily ever after. And so I'm still actively employed. As we said, I work for a large medical institution in the Houston, Texas area. I came to Houston in 2013. I've been investing in multifamily since 14. After starting in single family flips as a hard money lender. And as another number for a numbers guy, you said the number of properties I've been in. I've also say that of those 20 some properties, 7 of them have gone full cycle.
Nice.
And they have returned a 2.2x equity multiplier.
What? Let's pause here. What does that mean? Full cycle and 2.2x equity multiple. What does that mean?
So thanks for stopping me. So that means that I'm still in many properties they have not sold. But of those 20, 22 different properties, 7 of them I started in and they've gone full cycle or they have sold. So the partnership, the limited partnership was formed with the general partnership. The asset was, the business plan was achieved and we exited the asset, we sold it, and there's a return to the investors. And so when I look at all those over the last approximately 7 years, that means for every dollar I've invested, I've gotten $2.20 back, very simply. So for every dollar I've invested, plus along the way, the tax consequences that are always the golden nugget in these deals. And so I've also taken the liberty of, some people don't like it, but I've used the self-directed IRA on some of those, not all of those. So people want to get into assets. That's a vehicle because not everybody may have cash, but a lot of people have an IRA from a previous employer or something like that. That's the subject of another whole podcast sometime though. But real estate has been very good to me. I got enthralled with it in 2014. I got enthralled with multifamily specifically. I've been in a couple different large educational groups. I started in lifestyles here in Houston, gravitated towards the Sumrock organization in Dallas. And for the last couple of years, I've been in Rod Khleif's organization as a coach, mentor to some of his students. And I just really enjoy giving back. I enjoy talking to new people in the industry and helping them in their journey, because as you know, Abel, I'm sure you can attest, there's been many people built into my journey, and I'm thankful for that.
Yeah, that's so awesome, man. I'm privileged, I'm humbled, I'm excited to talk about this stuff. So there's a lot of things that I want to dig into. One, the fact that you're still working full-time today. You are a professional in your own, in the medical field, and you serve people at work, I'm imagining, in the healthcare field, and you make an impact there, but you're still working a good number of hours. And so in the full-time realm of being a professional, you were also made enough time to kind of, to put your money out there, to get invested in this kind of stuff and learn and educate yourself. There's a lot of people that want to do something like this and they just never do.
Yeah.
What was it that separated you maybe from other people that didn't take action?
So I'm not a doctor. I just want people to know I'm an administrative type in the healthcare profession today. But yes, I do have at least a 40-hour week. I wish it was 40-hour weeks. Let me put it that way.
Yeah.
But my journey to passive investing started when I was just before coming to Houston. I had been involved in a private equity company as an employee. Okay. And if anybody knows anything about private equity, it's a very grinding organization, and it's a short-term gig. It's 5-6 years, and that gig was coming to an end, and I found myself in that awkward position of having leaned my ladder on the corporate myth of getting a good education, going to work for a big company, and I realized that's going to be out of a job. And so I needed to find another income stream. And that got me into, just before I came to Houston, I had a brother-in-law who I really respected come to me after attending a large educational opportunity about single family flips. My journey started at the time I was living in Cleveland, Ohio, and a brother-in-law, very well educated, MBA, JD, came to me and said, I want you to become a hard money lender with me. This group I identified out of South Florida. And I said, we're going to lend money to a group we don't know, living in Ohio, in Florida, to buy an asset that we've never seen, we've never touched, and we're going to get a nice return. He goes, yep.
Yeah.
And It was like for the finance guy that I am at heart, that was a challenge. And so we buried through it. Long story, I gained comfort with it. We did many different flips. We got real comfortable with it. But when I came to Houston, I kind of got burnt out on the time to analyze every deal.
Super transactional. It's a lot of work. It is more work than most people expect. And they think, oh, I'm going to flip a house and make a lot of money. Well, yeah, you can make some money. Just got to do it a bunch of times and a bunch of times, right?
Yeah, and every deal you got to look at the comps. You got to look at the rehab plan. And at least in multifamily, you don't have to do that once.
Yeah.
At the time of acquisition. So, I got comfortable with it. Came to Houston, like I said, got involved in some of the large mentorship groups.
What year did you start multifamily?
2014.
Okay, cool. So you were in the syndication world. There's a lot of people that don't know that in 2012 is when some SEC laws changed and made it more favorable for us to get invested like this. In 2013, they implemented it, and that brought about the ability for non-accredited investors, somebody who didn't have $1 million net worth or wasn't making, 200, 300K a year, they couldn't get invested in this kind of stuff before. And they opened it up and they said, hey, if you have an existing relationship with somebody and you meet them and you can go do deals together. And so it sounds like you kind of started that path right at the time this opened up. You took full advantage of it as the moment you learned about it, I guess.
Well, there's a kernel that even I did not know. So that's good information. I did not realize that happened in 2013, but I am a beneficiary of that as a sophisticated investor.
As a sophisticated investor back then. Yeah. So I was like, not anymore. I credit all the way, baby. So I love it. And so what was it about multifamily investing as a passive investor with a full-time job that made more sense than what you were doing in single family?
Yeah, it was the time element and those very transactional. But I remember sitting in a session the first time and hearing about non-recourse debt. And I had pursued acquiring several different business opportunities over the years, but I always got hung up on the personal guarantees and the fact that, if I screwed up, they could come after my house, my cars.
There you go. There's your wife involved.
She would have left me.
And a lot of risk, right? I mean, it's a ton of risk when you're thinking about it. Jeez.
And that was like, why would they do this? But then as you learn, the government wants to promote affordable housing. They want to promote workforce housing, et cetera. And it makes sense. Plus the asset is guaranteed, and they tend to be the good ones, kind of a cash cow. So,
yeah. And for those that don't know what non-recourse, literally it's, if something bad were to happen to the property, nobody ever wants to lose our seed money, but your risk stops at your investment that you put in the deal. If you put in 50K or 100K, that's the risk. You're not taking a $10 million risk of a building behind you if something happens. And that's just a risk adjusted return in of itself. Jeez.
I have, on that single family, Abel, you can relate to just on that recourse, non-recourse. I had one of my last properties, single family, go sour, and I'm still chasing and suing the guy today. And I will chase him until I get some money legally.
Yeah.
But and then multifamily, as you indicated, there's just no ability for the lenders or anybody else to come after you or I personally.
Yeah. Wow. Then there you go. So that started the passive investing journey. And since then, you've invested in 20 properties, 20 opportunities. You've been doing this as a passive investor, and now you're an active investor as well, which is awesome. We'll talk about that in a minute. But what nugget can you give to somebody that's trying to figure out if they should invest passively or not? They maybe exactly talk to yourself 2013 before you found, somewhere in that area. I mean, what advice would you give them now jumping into this, looking at this the first time?
Great question. I would say, I had what I would call that significant emotional event in my life, which was going to get laid off. And that for me was what I would label as a significant. And so if you don't have one of those, And I would just say though, that, I mean, there's 3 reasons people invest in real estate, right? So as a finance guy at heart, I like dividend paying stocks if I'm buying stocks, but in multifamily, you have positive cash flow, you have tax favored treatment, and you have the other one that your investors need to know is that it's forced appreciation, right? So I mean, the beautiful thing when I bought single family houses, you always had to calculate what the comps were in the neighborhood. So I could have the best looking house, but if it sits in a neighborhood where everything else is ugly, it doesn't matter. You're never going to see the money. Well, you and I know that in multifamily, it's a business. So it's the valuation of the property is simply the cap rate. I mean, the asset price over the cap rate over the net operating income. And so that net operating income is what the business is all about. How do you increase that net operating income? Either you increase the revenues or you decrease the expenses or both, very simply. So I can force appreciation on a property by raising the rents or lowering the expenses. And that's forced appreciation that you can't ever get in single families. So very simply, there's cash flow, favorable tax treatment, and forced appreciation that made the recourse decision to me even like that was, candy on top of the ice cream.
It's amazing. But what a great summary, because those 3 points are like the core of why many of us invest in real estate, commercial multifamily specifically, and large. We're not talking about 5 or 10 units. We're talking about big deals, 100 units, 200 units, and the bigger the better, kind of sort of speaking, because when you have positive cash flow, renters are paying it. You get good diversification. Very rarely is you're going to have 100 people ever leave the apartment complex at once. So people come in and stay making the payment. That's where your positive cash flow is, more than what we owe the bank, just like a rental house where the mortgage is 900 and the renters come in and pay 1,200 every month. Well, it's positive cash flow on a single family. We do the same thing, but there's 100 single family rentals and they're all in one spot, right? I like the favorable tax benefits. So tell me about that for you. How's the favorable tax, benefits of this asset class worked out for you?
Yeah, I'm an MBA finance and a CPA, so I said that's my reference point. So that's in my wheelhouse. I would say that what's attracted me to it is just that. So for your investors, if you invest as a KP, as an LP, as a limited partner in an asset, at the end of the year, you're going to get a K1. That's a distribution of all the limited partners in the asset and what your percentage ownership is. And so you're going to show a large paper loss on your investment. Keyword paper loss.
Yeah.
But at the same time, you're going to have a positive cash flow if things are going. You're going to receive distributions monthly or quarterly, depending upon the asset. But at the end of the year, you're going to get a large paper loss on your K1 that you're going to, depending upon where you are in your individual taxes, you'll either be able to take advantage of immediately, or at the worst case, it would get suspended on your tax return until you sold the asset and would offset your gain. So you don't get that in equity and bond funds, right? You may get distributions, dividends, but they're all taxable at the time they occur. The other thing I got to jump in, you were talking to remind me, the other thing I love about as we talk about the merging S&P 500, the Dow, whatever you track, it's today, it's all based around Facebook, Amazon, Netflix, and Amazon or Google.
Yeah, the FANG.
FANG, thank you. That's what I said, Google.
Yeah.
And so, and I'm a tech guy, I love it. But the reality is it was a decade ago, we talked about Walmart as the darling of Wall Street. Sure. So there will be another darling someday, but people are always going to need a place to live. They're always going to need a place to live. And with the widening gap between the middle class and the upper class today in America, there's a lot of I have adult children that have good incomes, but they don't have the balance sheet to put down a down payment on the purchase of a house. And that's a sociological change from my generation to the current generation, that people just can't afford to buy a house. So there's going to be renters for a long time. There's evidence that we're becoming a nation of renters. I read someplace recently there's an estimated 100 million out of the 325, 350 million across America that are renters. And you compound that with the items we just talked about: cash flow, taxes, forced depreciation, non-recourse debt. I just haven't found an asset, and I still have my 401k and stuff from my employer, but I just haven't found an asset class that I think beats this.
Yeah, I love hearing the MBA, the finance, the individual like yourself who knows numbers, who enjoys working with them, say, I have never found an asset class that beats this. And I'm like, yep, I love it. I'm not the finance guy. I'm not the the hardcore accounting number, but I understand the simple math. When I was a W-2 employee and my wife was our real estate professional, she managed our portfolio of single family houses, which my CPA said, buy those houses because you're going to get a tax loss every year. Buy them and it'll help you deduct some of your taxes on your W-2. Well, I was a high performing sales executive, so I was making 250K plus, and my taxes, I was paying 50 to 60K in taxes every year. And so I buy more houses, and I got to 5, 6, 7, 8, trying to get more. But this, the tax bill never went away until first year. My wife finally stayed from the house. She was at the house. So she managed our portfolio, and she was the real estate professional in the house.
Right.
And we put 100K into a couple of deals that year, cash, and we wrote off 100% of my taxes that year. And I got a 30K refund check, which it didn't take a finance guy for me to realize. Put 100K in, reduce 60, and get 30 in hand. I'm in. I'm like full bore in. So that was my jump. But it's awesome hearing you say this.
To your listening audience, the only downside I can see to multifamily investing is I think your audience and people that I talk to have to understand, it's a long-term investment. It's not liquid. You're going to get distributions, as you and I have talked about, but it's not like buying a stock that, I changed my mind a year into it. I want to get my 50K back.
Yeah. Nope.
That is highly unlikely.
Liquid investment. That's for sure.
They are possibly could be sold, but they'd be sold to one of your fellow LPs, limited partners, and it's doubtful they would want to pay you what you want for it.
Yep. So this is a great point, because a lot of people will ask me, they see, hey, you're doing awesome. You're buying some deals and you're getting involved, KP passive. A lot of my friends, investors, they reach out, well, what's the cash flow? How much am I going to get back this year? I go, not much. Like, you're not going to be able to retire off of it. Not unless if you have maybe $1 million cash investment invested potentially at a 6% preferred return, and it's providing you distribution. That's 60 grand that could come in every single year. Most of the people that I work with are not doing that $1 million single shots. They're doing 50, 100, 200K ish. Yeah. And I go, it's not going to change your life today. It'll change your life when your 200K gets invested and it doubles in 5 or 6 years and it becomes 400K, and you go stick that 400K back again, and in another 5 or 6 years, it becomes 800, and let it ride a couple more times, and it starts to steamroll and build up. Now this one seed that you planted keeps providing and providing and providing. And the goal is to plant as many seeds as possible. And, my lifestyle hasn't changed, Randy. I don't know if yours has, but my lifestyle has not changed, other than the fact my net worth keeps growing. Yeah. And I'm like, man, this is amazing. So anyways,
you're the same person you were 20 years ago. And however you spent then, I still drive a 9-year-old car.
I love it. Yeah.
I still drive a 9-year-old vehicle that by anybody's definition is not impressive, but it gets me where I want to go. Yep. And so I think you're right. Slow and steady wins the race. It's the hare and the tortoise example. Slow and steady wins the race. you can get rich off one deal, but it's unlikely you're going to be able to retire on one deal. But over a period of years, I mean, the illustration I give, Abel, is I know, I really can only think of one off the top of my head, which is Warren Buffett, who made his money through the stock market. I'm sure there are more, but that's the only one that comes to my mind.
Sure.
But I can name you 5 to 10 people that I know of that have become independently wealthy, not Warren Buffett style, but many, many millions of dollars off real estate.
Yep.
It is a tried and true method. You don't need to be smart. You just need to understand the playbook and be in the game.
Absolutely. And get in the game, right? You need
get in the game.
You need to get in the game. And some people, it's hard for them to, it's a perceived risk. I'm going to give $50,000 or $100,000 and I don't even know where my money's going to go. Well, you do it every day in the stock market. I mean, that happens easily. I give money every 2 weeks to the 401k. And you're like, I don't know where it's at. I don't know what those CEOs are doing, but it's, perceived risk. Anyways, if we can.
And you don't know, I always tell people, I know where when I'm investing as a limited partner, I know where my general partners live. I mean, I literally know where they live and how to get a hold of them. Try to get a hold of your mutual fund money manager, right?
Oh, yeah. Good
it's
luck,
impossible.
Right? I love it. So anyways, this is a great kind of conversation. And as we're talking, hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. You have a lot of experience as a passive investor. I think, some of the most of the experience that I've heard a lot of GP and general partner and key principal. You have both. A lot of passive and a lot of general partner. What's the difference between we throw these letters around GP, KP, LP. Let's describe the difference so people understand a little bit. And I think this would be helpful for those.
Yeah, happy to do so. So generally, most of these assets are, as you know, formed in a limited liability company or an LLC when they're bought. That's the preferred legal entity for purchasing multifamily for risk questions. And in any limited liability corporation, there are general partners, GPs. You'll also heard the term sponsors. So general partners, GPs, sponsors, they're all synonymous terms. Or you'll hear passive LPs or limited partners, they're all synonymous terms as well. But generally, the general partners, the sponsors in an asset are the ones that make the decisions. They're the ones that go out and find the asset. They're the ones that put down hard earnest money. They're the ones that do the due diligence. They're the ones that put the syndication together, attract all the investors. They have some risk, but they have more risk than the limited partner who has none. As you said, the limited partner has no decision-making capabilities, but they have no risk other than their investment. The general partner does have some risk if they were to violate the loan covenants or create fraud. They're referred to as the bad boy carve-outs in the agency loans. If the general partnership were to do fraudulent activities, the agency loans could revert to recourse loans, and they could, but that's not going to happen if you're smart at all. And so GP,
we want a team of good people that are all doing good business, and
absolutely.
everybody wants to win, not to mess up. But go ahead. Yes.
Yeah, I mean, in reality, the United States is a big place, but when you start talking multifamily, it's a small space. I mean, reputation is readily deciphered, but KP is the last element. That means a key principle. So when you're looking at debt financing to buy an asset, most syndicators look for agency debt, which is Fannie Mae or Freddie Mac. And to have those, you just can't walk into a loan broker and say, hey, I want a $5 million deal to get this apartment. You have to have experience. And so to be an experience, you have to have already bought an agency, an asset with an agency loan, a Fannie Mae or Freddie Mac. Well, how do you do that if you've never done one before? Well, you partner with somebody who has done it before, and you become what's called a key principal. Because if they're buying if the sponsorship is buying a $10 million asset, they have to demonstrate to the lending agency that they have a combined net worth of $10 million or greater. So a la the entrance of a key principal, let's say the major guys only have 9,999,000 of net worth. So in that case, they would invite a key principal to come in who would sign on the loan to push them potentially over that threshold. And the advantage to that, it's great for the syndication, it achieves the objective, but also it allows that person signing on the loan to get their agency, their Fannie Mae or Freddie Mac card, or the ability to do future ones. So that's the way I did it. I started out as an LP, and then I signed on a loan as a KP. We still own the asset today, and then I became a GP.
Yep.
And I could get an agency debt because I had been a KP.
Yep, that's it. I love it. It's a team sport. We work together. We put together strongest team we probably have in our networks at the time of the deal, and we all look together to go try to make sure the numbers are right, the analysis, funding it, financing it, operating, executing it, and the right strategy to sell or exit. And then our investors are passive, and they get in and they make their good return. Like Randy said, 7 of his deals have exited, 2.2 is money. If he put a 100K in, he's come out with 220K back, which is amazing. And that was passively. And then now, as some skills have built up and some track record and expertise, he has in underwriting any number of deals, and also his network has been growing. Now he can participate in the general partner side, sign on loans, and now his track record also begins on that side of the house. And it's just where you want to get in. And I'm not sure how long you're going to stay in this professional world, but I think soon you'll eventually have a final day at the W-2 job and enter full-time real estate Randy. So I'll be scared of you then, brother.
Well, that will happen one day, but I would say at this point in time, the other thing we got off track a little bit. I mean, I would say I think the other thing, the encouragement for your listening audience is this something that can be done part time.
Yeah.
You don't have to jump right in and become a 50-hour a week general partnership analyzing deals or whatever.
Yeah.
You can go at your own pace. I said I started in because I was risk adverse, accounting, finance background. Didn't believe anything anybody told me. I was from Missouri. You had to show me. And with that, gained comfort with the model and the non-recourse, the 3 items we talked about, and understanding how deals are analyzed and how to invest in things. The most important thing I think your listening audience can do is, which they are doing by being here today, is they're getting educated.
Yeah.
So by evidence of listening to this podcast, that's one element of educate yourself.
Yeah.
Do you know how to decipher, a good deal from a bad deal? Because it is buyer beware.
Yep. Yeah. I love everything that you're saying. And one of the things that you touched on real quick, and I didn't hit on, maybe I'll expand now. If you've never heard some of these terms that we're talking about, or you never had your eyes open to, I can invest passively in something, a much bigger deal with the same amount of money. it took what I think Randy I heard was he started taking education and courses and networking, and you went to Lifestyles, you did Sumrock, and now Rodcliffe. Those, if you don't know who those are, they're basically like education platforms, courses, seminars, some coaching that you can go and pay for. And Randy, I didn't do Lifestyles, but I did Sumrock. I've gone to many multiple Rodcliffe events. I've done a bunch of Adam Adams events. I hired a coach that I work with once a week. And then I joined Apartment Educators and did that round. And now I kind of coach, for new syndicators that are trying to go active and do the same thing. And and then I joined, just recently joined Hunter Thompson's, raising capital, mastermind. And I've done Kingdom REI Masters, a Christian real estate mastermind. And every single networking platform, I call it networking platform, every single education course and seminar and thing that I joined, it's opened my network up to new investors, to new opportunities, to new partnerships, to new education. And even if it's some of the same education, just me hearing it a 5th time, a 10th time, a 20th time, it all really helps, push the momentum forward. Would you agree?
Oh, absolutely. I mean, yeah, I've been doing it for 7 years now, and I wouldn't consider myself proficient by any means. I'm still learning. It's the old adage: when you're done learning, you're done.
Yeah.
And I think that that's particularly true in this industry. And even though you hear, I was going to say, oh, you're a slow learner like me, you have to hear repetition because
Yeah.
that's the way I learn. Oh,
Yeah.
the 5th time, Randy will get it.
I got it.
But the other thing I would encourage your audience is those large educational groups that we talked about are great, and there are other ones across the country, wherever you're at geographically. But 2 things I always offer up is, one, there's the low cost. I'll say it. There's podcasts. There's tons of books.
Completely free.
When I moved to Houston, Texas, I was going to a real estate meeting every night of the week. My wife and family had moved down here. So the point of it is there's tons of meetups.
Yep.
If you have the energy and the time, you can get an immense amount of information just by attending meetups, listening to podcasts, books. And I say, I started out, I was adverse to paying a large educational organization funds.
Okay.
I'm like, no, this is a ripoff. Well, what I gained or learned to understand is I finally came to the conclusion, I invested a lot of money in my college and postgraduate work, a lot of money, right?
Mm-hmm.
And I and my parents didn't think anything about that. Why do I have a hard time thinking hard or thinking bad about investing a couple $100 in an educational program?
Yeah.
So people are adverse to spending money to educate on real estate, but yet you're gonna potentially give somebody $50,000 or $100,000 of your hard-earned money and not know where that's going.
Deal or not, right? Yeah.
That to me is called speculation versus investing.
So. I love it. What a great mindset. Yeah, because like you said, you and I mean, spent some good amount of money. I didn't have the MBA, so I didn't have to spend as much money, but it was a ton, and we signed up for it, and it was like, yeah, so what we're expected to do, here's thousands of dollars. And in the end run, some people have a hard time about spending a few thousand bucks, and it could be the best investment of their life.
Even in my MBA, I mean, I had a corporate sponsor paying me, but the reality is I invested a ton of time, right? So your audience can invest a ton of time if that's the venue they want to go, or they can jumpstart it and pay some money.
Yeah, well, this is great. Randy, before we go, let me make sure I hit this. If our listeners want to connect with you, who is it that you want to have reach out to you, and where should they go?
Abel, I'm just want to thank you again for being on the podcast. I'm interested in basically helping anybody that wants to call or spend the time on a conference call or an email. I'd love to get to know you if you have any interest in investing in future opportunities. And the easiest way to get a hold of me is go to my webpage. It's invest-ark, invest-ark.com. And on there is a contact page. You can send me an email, or you can schedule a quick call, 30-minute call. Would love to talk to anybody in your audience, Abel, and get to know them a little bit better and help them along the journey as people have me.
Yeah, that sounds awesome. Thanks a ton, Randy. And I have a couple more questions, so don't go just yet. But for those people that are thinking about investing passively, could you give us maybe a couple of bullets? What should I be looking for when a deal comes out, when an offering memorandum comes out? Just pick apart a few things that you look on any one of your 20 investments, and that way that gives some last parting insights for passive investors.
You're going to challenge me to do this quickly, but because I can talk for another hour about this, but it's all good. So I would think I would start with, if I were coaching, and I have coached people from Rod's organizations and doing this, so it's the illustration of the horse and the jockey that I'm sure you've heard of before. The horse, what's more important, the horse in the horse race or the jockey on the horse? So in multifamily, the jockey is the sponsor or sponsorship group, and the horse is the submarket where the asset is located. And so I would encourage your listening audience that the sponsorship, or that illustration, the horse, is the most important thing to consider. Get to know sponsors, general partners, whatever you want to call them. Reach out to them. If they don't want to spend the time with you, that's a red flag. But the simple illustration of the sponsorship group is paramount in my mind. And then after you've gained comfort with them, get to know them, ask them questions, ask about their track record, ask them what they got coming down the pike, what's their minimum investment. So for me, when I look at investments today, it's the sponsorship group and where it's at. Because otherwise we chase this. I tell people to have their own written plan. So otherwise we chase this, what I call the shiny object syndrome. Something comes across my desk from Topeka, Kansas, I'll say, and no offense to Topeka, but with a 30% IRR.
Yeah.
Well, that's great, but I'm not interested. It's in Topeka. Or Abel sends me an offering from San Antonio. I'm in. I know Abel. I know San Antonio. There's, that's two of the big elements. So the sponsor, the submarket, and then you just really got to understand the intricacies around it. What's the business plan? Is it a yield play? Is it a value add? Is it a repositioning? The sponsor should be able to demonstrate rent comps and what they know about the submarket, and really digging into that business plan, right? Yeah. The biggest one I see is my wheelhouse is the underwriting assumptions. So what's the capital stack look like? Is it 80-20, 70-30? I've seen them go as 50-50. So for your audience that just maybe started, that means that 80% of the proceeds go to the limited partners and 20% go to the limited partners and 20% go to the general partners. But they vary. There's the debt structure. What are the underwriting assumptions? Growth, expense, cap rates. One that I think is really under considered, and one most often overlooked, is property management. So if Abel's got a deal in San Antonio, that's great. But if Abel's going to New York City, if you've never been there before, I as an investor would say, hey, well, how you doing in New York City? What's the relationship with New York City? Who's your sponsor? Who's your property management company? What are their track records? What are their experience in that asset class? And so then I think fees are important. You got to look at it, investor, what are the fees? And I haven't even talked about the projected returns, right? What is it that you want out of the investment? Are you looking for, I got one high net worth guy that says, Randy, just give me 5-6% a year. I'm happy as a pig in mud. I got other people that want
to crush it. Yeah, he'll crush it.
And I got other people that tell me they need to see double their money in 5 years. That used to be the standard. It's getting tougher and tougher. So
yeah, I started saying 6. I started saying 6, which is the rule of 72, right?
Right.
A good investment, passive investment, compounding 16% year over year over year is 72 months. Money doubles at that rate. So anyways, I'm like, yeah, if I can find that, I'm going to go do that deal.
And as an investor, take that all day, every day, personally.
Yep.
Maybe somebody else won't though. So, I mean, that's why it goes back to develop your plan. So I'll shut up and say, develop your plan as the investor, know the sponsors, know the submarket.
Yeah,
So,
I love it. What a great party nugget. Is there anything else we haven't covered today, Randy, that you were really wanted to bring some exposure to, or just, leave as parting words? Anything else that we didn't talk about?
I'm sure there's something, but I can't think of it off the top of my head, other than, we could drill into any one of those topics for a whole session. But, I've just really appreciated being on your show, Abel, and keep doing what you're doing for the investors out there in the world.
Yes, sir. Thank you so much, Randy. It's been a pleasure, and I really appreciate your time. Humbled, appreciative, grateful, and I look forward to staying connected and being in your network as well, my friend. And hopefully we'll see you soon when all these events kind of come back to in person. We're having our first in-person meetup at the end of May. So May the 25th here in San Antonio. Nice. We are hosting a boot camp at the end of June, 20 something. I'm going to my first conference, the Multifamily Investor Nation. I'll be one of the panelists or speakers over there in Florida in July. So these are like literally my first, outside of the world events. I'm excited. And I think we're going to a mastermind in October. So I'm like, oh, here we go. Boom, 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 boom. Starting again. So.
But you're continuing your education and you're continuing your networking and compounding. So kudos to you.
Make it happen. Randy, thank you so much again. Appreciate it. Everyone that's listening, I know you got some value from today's show. Go to our podcast, subscribe, rate, and review. If you haven't done that and you've listened to like 160 shows, I need you to go do that right now. There's like 45,000 downloads since September. I need you that's been consuming the podcast, go leave a written review, and then also go to Randy, ping him and let him know you heard him on our show. I'd be blessed. And thank you very much for the opportunity. And thanks for joining. Thanks, Randy.
Thanks, Abel. Appreciate it.
Talk to y'all soon. Bye-bye. Thank you for listening to this episode of the 5 Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.